I save in gold. I don't invest in gold or speculate in gold. I save in gold.
Me
So
too.
it occupies a very different bucket for me.
Hmm.
Uh, and I have in the past speculated in silver. My silver speculation had to do with the fact that for a long time it was a hated asset class. And my
Yeah.
belief was that gold would run, and when gold ran, the silver would run, and it would become unhated. Well, that occurred. And so I sold 80% of the silver I had in my speculative bucket. May return if in some future conference we notice in the attendee notes that they hate silver. If silver becomes hated again,
You going to
I'll
start
likely be a
buying?
buyer.
The recent weakness in gold has led many investors to question whether the precious metals bull market is losing momentum. However, short-term price movements often mask the larger economic forces at work beneath the surface. Rising interest rates, recession fears, and stronger dollar sentiment have created temporary pressure. But these factors may not be enough to change the long-term outlook. Rickrule, a veteran resource investor and longtime advocate of precious metals, explains that gold should be viewed primarily as a savings vehicle rather than a speculative asset. He believes many investors misunderstand gold, treating it as a trade rather than a form of wealth preservation. According to this view, today's environment resembles periods in history when governments sought to combat inflation by raising interest rates. While those policies temporarily weakened gold, they eventually exposed deeper economic vulnerabilities. The discussion highlights how inflation remains a persistent challenge despite official statistics suggesting otherwise. If purchasing power continues to erode and policymakers struggle to maintain economic stability, gold could eventually attract far more investor attention. Looking ahead, a return to precious metals could support significantly higher gold prices over the coming years. Now, we present the clips from Rick Rule's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
My own life is driven fundamentally as opposed to technically.
Hmm.
I would suggest that the recent softness in the gold price has to do with three factors, the most important of which is higher U.S. nominal interest rates. Higher interest rates increase the attractiveness of the U.S. dollar and are tough on the prices of U.S. dollar denominated assets, with the possible exception temporarily, of course, of SpaceX.
Yes.
Uh, they also, I would suggest, correlate reasonably well with fears of a recessionary or a deflationary recession. And I think that people are concerned about the possibility of a credit collapse and a recessionary circumstance derailing inflation. I think that most of those fears are misguided. I can't tell you where the gold price will go in the near term. Nobody can, although many
Hmm.
people will try. But I can tell you that the period that we are going through currently reminds me personally of no circumstance as much as 2000, as pardon me, 1975. And let me take some of your younger listeners through that period. The period 1970 to 1975 was characterized by an increasing fear of inflation in the population and an increase in the gold price from an admittedly price controlled $35 an ounce to a high, if my memory serves me well, of about $200 an ounce. The political fears around inflation caused the US Congress to do something fairly unusual. They decided to do something about it, and they allowed interest rates to rise. And that increase in interest rates cratered the price of gold from about 200 to about 100. It cratered some other things too. The US bond market, the US equities market, durable goods sales, new home construction.
Yes.
Uh, and after a fairly brief period of time, Congress and the American political class, in fact, the voting class lost its nerve and abandoned any pretense in defending the sanctity of the US dollar. When interest rates were forced down, it became clear to savers and investors around the world, not just in the United States, that political expediency was more important than the sanctity of the sanctity of the dollar. And after that happened, after the interest rates were engineered down, the gold price exploded from a low of about 100 US dollars an ounce to a high of about $850 an ounce. It took two things: very high real gold prices, and then a tripling of the U.S. interest rate under Volcker to finally break the price of gold in 1981. Gold then had to compete with a U.S. Treasury selling at 15. Uh, we're a long way from there. By the way, David, I am not suggesting that anybody have 100% of their net worth in gold or SpaceX or
Hmm.
anything else. The future is a set of probabilities. There's no certainty whatsoever. But I would suggest that for the American investing public, at least, I can't comment on the Canadians, that gold, the market share of gold and gold related securities relative to other savings and investment asset classes is 0.5%, down from a 4-decade mean of 2%. I believe that we will, over the next 10 years, experience at least a reversion to mean. I also believe, and it's important to note this, that the subject of inflation in the United States and Canada is dominated by an indicator, the CPI, which I believe to be false. The CPI, and we've talked about this before, David, but some of today's listeners won't have heard it. The CPI, when it's inconvenient, doesn't include food or fuel, which makes it of very little interest to somebody who drives and eats and flies.
You're talking about
Uh,
core CPI. Core CPI doesn't include
yeah,
fueling
and
food,
it
right?
doesn't include tax.
Yeah.
If we didn't have to pay the tax, I guess we couldn't complain about the index. But the truth is, as a cost of living index,
Hmm.
it's silly. I would suggest that if your listeners looked at the basket of goods and services that's necessary for their life, and they contrasted the price levels that they paid in 2020 with the price levels that they pay now, that in fact, the deterioration in the purchasing power of their dollars, be it Canadian or US, would be closer to 8 or 10% compounded than it is to the more recently restated US CPI of 3.9. Politicians exist to exercise power. There's no other reason why they would subject their family and themselves to what they have to go through. Their currency is power. Gold reduces that power. The power to allocate to your friends, the power to spend, the power to mandate circumstances that the economy wouldn't otherwise allow is what politicians live for. The discipline that would be imposed on politicians by the gold standard makes it completely implausible that they would embrace it. In non financial terms, why would anybody choose to become a eunuch? To the extent that politicians imposed a gold standard on themselves, they would become financial eunuchs.
A major theme of the discussion is the difference between saving and investing. While many investors focus on maximizing returns, preserving purchasing power may become increasingly important during periods of persistent inflation. Gold is presented as a tool for maintaining wealth rather than generating rapid profits. The conversation also questions whether official inflation measures fully reflect the rising cost of living that households are experiencing. When food, energy, housing, healthcare, and other essentials continue becoming more expensive, real purchasing power can decline even when economic statistics appear manageable. If inflation remains structurally higher than expected, capital could gradually shift toward hard assets. Such a trend may strengthen demand for gold and potentially create favorable conditions for silver and mining shares as investors seek protection from currency depreciation. Now, let's get back to the interview.
The damage that has been done to the US economy in terms of expenditure and the damage that's been done to the global economy by higher energy prices, which has the effect of a tax, will take months and probably years to undo. The extent to which money that would otherwise have gone to other activities has gone to energy producers or energy companies exacerbates, I suggest, the credit quality cracks that were already appearing in global markets. The problems that you've seen as an example in private credit are well documented. Lower liquidity, which is the consequence of higher energy prices, exacerbates that. I'm not suggesting that depression or recession is around the corner. I'm just suggesting that people's viewpoint, which is to say, if the war were to end tomorrow, that we would never have to pay for it, are naive at the very best. Well, I think if you look at the S&P and you try and subtract out, in other words, you try to adjust it for purchasing power,
Mm.
I would suggest that if you looked at the S&P in gold terms, that the performance of the S&P since the year 2000 has not been all that good. If your earnings, I'm just talking hypothetically, if your earnings increase at 5% a year, but the purchasing power of your earnings decreases by 7 or 8% a year, despite the fact that on paper that 5% gain looks good, you end up being, in terms of purchasing power, 3 or 4% annually worse off. So my suggestion is that if you look at the purchasing power expressed by a unit of the S&P 500 in the period 2000 to 2026, that the picture looks substantially less rosy. One must look at both the numerator and the denominator. I save, David, as I think you know, mostly in gold. I maintain liquidity in Canadian dollars and occasionally, pardon me, in US dollars and occasionally in Canadian dollars. And when I look at the basket of goods and services that I acquire today, in the context of my savings, in the context of gold, I'm struck by how cheap real estate is. I'm struck by how cheap healthcare is. I'm struck by how cheap food is. I'm struck by how cheap energy is. When I started saving in gold, gold was $250 or $260 an ounce. And if I measure the S&P performance since the year 2000 versus gold's performance since the year 2000, then the increase in the S&P doesn't seem that attractive, nor frankly does the increase in the gold price. Well, no, I did. I won't say I held gold during that time. I bought gold continually during that time.
Hmm.
The last time I sold gold was in 2009. And I didn't sell gold in 2009 as a consequence of the fact that I thought the price was going down. I bought it because I owned it as liquidity, and there were other asset classes that were cheaper.
Hmm.
Occasionally, seldom, hopefully, one dips into one's savings to acquire assets that will increase their material standard of living. After the equities market collapse of 2008 and the credit market collapse of 2008, in 2009, there were a variety of financial assets that were on sale at such ridiculously cheap prices that they caused me to liquidate a bunch of my gold to buy, albeit temporarily, asset classes that were cheaper. For me, savings are just exactly that. I'm not trying to make money on my savings. I'm trying to maintain the purchasing power of my savings. I make money investing, which is differently than saving. I make money investing in high quality businesses or speculating
Mm.
in businesses that I believe might become high quality business, or investing in private businesses like Rural Media, the Rural Classroom, Sprott in the old days. But I save. I maintain my purchasing power in gold, unless we have another 2008 style psychotic break in the market. I imagine personally, David, that the sell decision with regards to my bullion will be made by my estate. I'm a systematic saver in gold, and I'm not particularly price sensitive. The only thing that causes me to sell my gold are opportunities that I find dramatically more compelling. I told you
It's going to
that
go
the
higher.
oil industry on a global basis was underinvesting in sustaining capital to the tune of $1 billion a day. And that would lead to higher prices by 2029, 2030. They're underinvesting by more than $1 billion a day. Can you imagine how much sustaining capital right now the UAE or Saudi or Iran is spending? In
Yeah.
addition to the underspending on sustaining capital, we need to rebuild all the stuff we're blowing up right now. That means that the prices that we're paying today are prices that are likely to be with us in 2029 or 2030. It
Hmm.
wouldn't surprise me in 2027 or 2028 to see the prices go down. But the truth is, anything could happen from here. If the war's over tomorrow, then the prices crater. If the war isn't over tomorrow and we begin rationing oil by availability, then the oil price goes much higher. So, no, my oil stocks are not for sale, personally. It may be that I suffer 2 years of penury as a compensation, as a consequence of that. I don't care. I don't live in 2 year periods.
Another important point is the long-term impact of government spending, monetary policy, and rising energy costs on the global economy. Higher energy prices act like an additional tax on consumers and businesses, reducing liquidity and increasing stress across financial markets. Even if geopolitical tensions ease, the economic consequences may continue for years. The discussion argues that many investors underestimate the extent to which inflation has affected real wealth creation. Asset prices may rise on paper, but if the purchasing power of money falls faster, investors can still become poorer in real terms. This is one reason gold continues to serve as a benchmark for long-term value. Looking ahead, the outlook for precious metals remains constructive. If economic growth slows while governments continue relying on debt and monetary expansion, demand for safe haven assets could increase substantially. Gold may benefit from a broader reallocation of capital, as investors seek protection from declining currency value. Silver could also outperform during periods of renewed investor enthusiasm, given its smaller market and historical tendency to accelerate after gold gains momentum. While short-term volatility is inevitable, the longer-term trend for precious metals could remain firmly upward if inflation, debt burdens, and monetary instability continue to expand throughout the decade. Share your thoughts about this interview in the comments section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.